Welcome to Ms. Accounting Tutor's presentation on Perpetual Inventory System Journal Entry Cells. My name is Mary J. Collins and I will be your host. A merchandising enterprise is a company that resells items purchased from a supplier to the public. During the process of selling merchandise, the company must keep track of the cost of the goods sold to the customers, as well as the sales price. The cost of goods sold is the price the retailer pays the supplier for the merchandise sold to the customer. The sales price is the amount the customer pays the retailer for the goods. Let's take a quick look at and a refresher of components and format of a general journal entry. We have a date column with the day and month, an accounts and title and description column which has one debit at least and one credit. Note the credits are indented, and a third line for a description of the transaction. Please keep that description concise and short. Thank you. Now you will have a debited amount will go on the left side. Credit amount will go on the right side. These two items must equal one another. Now, let's look at our first journal entry for the sales of merchandise. A sale of merchandise to a customer on credit. This activity requires two sales journal entries, one to record the sale and the other to remove the inventory from the inventory account. Sale of merchandise on account. On January 7th, which is the date, we'll put 1/7, we sold merchandise on account, 2 dogs for $800 to a customer. Since we sold on account, we will use accounts receivable. Then we will do sales revenue, which is to record the revenue, and the description will be to record sales. The cost we charged the customer was $800, so we will debit, therefore increasing the asset account receivable by $800, and we will credit sales revenue, therefore increasing the record keeping account sales revenue. Now we will do the journal entry to remove that amount from our inventory. We will start with cost of goods sold, which we will debit for the amount of the inventory we sold, and we will remove that from our inventory account with a credit, and the explanation is to record removal of goods sold. So the amount we paid for the inventory was $300, so we will debit increasing cost of goods sold, and we will credit inventory, an asset account, thereby reducing that account. This is the example of how to record a sale of merchandise on account in a merchandising inventory that uses perpetual inventory. Okay, sales returns. Customers return defective or undesired merchandise to the seller if an allowance is granted due to the damage or displeasure with the inventory. Then only use the first of these two journal entries. Otherwise, if merchandise is returned, please use both the journal entries. Now let's talk about sales returns. Here's our example on January 12th. We'll put the date here. Customers return one of the dogs, so we'll do sales returns and allowance, which is a contra revenue account. It will reduce the amount of sales. And accounts receivable, because of course we'll be reducing their account for the amount of the return. Return of one dog is our description. We charged them $400. We'll be returning that amount, so we will debit sales returns and allowance, which increases that account, and then we will credit accounts receivable, which will decrease that account. We will then record the return of merchandise, so we'll increase our inventory and decrease our cost of goods sold. The explanation: return dog to inventory. The amount we paid was $150 for the one dog, so we will debit inventory, therefore increasing that, and credit cost of goods sold, which will then decrease our cost of goods sold. This is how to record the return of merchandise on account. Customer payments. Cash payments made by customers for merchandise purchased on credit or on account at an earlier date with a cash discount for early payments. We often offer our customers cash discounts for early payments. So, let's look at the example. Customer payment on account. On January 17th, which is the date, 1/17, received payment. So we're receiving cash, and they received a 2% cash discount. So we will do sales discounts, and then we will credit accounts receivable for the full amount they owed. Since they returned one of the dogs, they now only owe the $400 for the one dog. So we will put the explanation: received payment from customer. We will take the $400 and we will credit the accounts receivable for the $400, therefore reducing their account. We will multiply it by the 2% for an 8% sales discount, which will be debited. This increases that account. And then we will minus the $8 from the $400 to get the amount of cash we received, which is $392. And this is how to record the payment of a customer on account during the discount period for the amount owed. Now, links. I have my list of common account titles placed in categories. There is one on Perpetual Inventory System journal entries. This is for purchases and sales. And then we have the one for my website, which is used by CNM students. CNM students will need your username and password to access this website. Thank you very much for your interest, and I will see you on other videos. Bye.